Hey everyone, welcome back to Corporate Decoder. Today, XZO just filed their second quarter 2026 10Q report, and I am seeing a big shift in their investment strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. They've made a massive move into US Treasury securities, and this really changes their balance sheet. So, X.Z.O Group Incorporated is a company that provides technology and operations solutions for property and casualty insurance companies. Think of them as the tech backbone that helps insurance companies manage things like underwriting, policy administration, and claims. They have a platform called the XZO platform, which is designed to streamline all these complicated insurance processes. Let's dive straight into the numbers because that is where the real story is. Looking at their balance sheet for the 30th of June 2026 compared to the 31st of December 2025, the first thing that jumps out is their cash situation. Back in December 2025, they had a hefty $305 million in cash and cash equivalents. But by the 30th of June 2026, that number has dropped significantly to about $137 million. Where did that cash go? Well, look at this line item, fixed maturity securities available for sale. In December 2025, they had zero in this category, but by June 2026, they've put nearly $197 million into these securities. Specifically, these are US Treasury securities. This is a huge shift. Likely a strategic move with the proceeds from their IPO back in November 2025. They are clearly putting their cash to work in very safe, government-backed investments. Now, let's talk about how the company is making money. For the 3 months ending the 30th of June 2026, their total revenue was about $58 million. That is a small increase from the same period in 2025, when it was just under $56 million. It is not explosive growth, but it is positive. Their main revenue driver is underwriting and management services, which brought in about $48 million for the 3 months ending the 30th of June 2026. This is up from around $45 million in the same period last year. This growth is attributed to bringing on new customers at the end of 2025 and also growing with their existing clients. However, their claim services revenue took a hit. It dropped from about $8.6 million in the first quarter of 2025 to just under $6.8 million in the first quarter of 2026. This is a pretty significant decrease of over 21%. The company says this is mainly because there were fewer catastrophe-related claims in 2026 compared to 2025. This makes sense as claim services revenue can be very volatile depending on weather events. When we look at the cost of providing these services or cost of revenue, it actually went down. For the 3 months ending the 30th of June 2026, it was about $21 million, down from over $22 million in the same period of 2025. A big reason for this drop is the reduction in outsourced claims, which fell by over 60%. This also ties back to fewer claims being handled. This combination of slightly higher revenue and lower costs led to a nice bump in gross profit. For the 3 months ending the 30th of June 2026, gross profit was nearly $37 million, up from about $33.5 million in 2025. That is about a 10% increase. This improvement in gross profit margin going from around 60% to over 63%. Is a positive sign. Now, their operating expenses saw a big jump selling. General and administrative expenses more than doubled, going from about $3 million to nearly $5.8 million. This is a huge increase of over 95%. The company explains this by saying that a larger portion of their compensation costs are now being classified as general and administrative. And they also have higher costs associated with being a public company and growing their business. Despite the jump in operating expenses, the company managed to increase its income before taxes. For the 3 months ending the 30th of June 2026, it was about $31.4 million, up from $28.9 million in the prior year. This is about an 8.8% increase, and a big reason for that improvement is a massive jump in investment income. It soared from $763,000 to nearly $3 million. This is thanks to those new US Treasury securities they purchased, as well as higher balances in their cash accounts earning more interest. Ultimately, all this led to a net income of about $23.3 million for the 3 months ending the 30th of June 2026, an increase from $21.7 million in the same period of 2025. That is a solid 7.4% gain. Looking at the first 6 months of the year, the trend is similar. Total revenue is up by about 4.4%, reaching over $113 million. Again, underwriting and management services are the main drivers of this growth, while claim services revenue decreased. Cost of revenue for the first 6 months decreased by about 5.2%, largely due to those lower outsource claims fees. But those operating expenses, especially selling, general and administrative costs, nearly doubled for the first 6 months as well, going from $5.6 million to $11 million. This significant increase is a major factor impacting their overall profitability picture for the year. And again, that investment income shows a huge increase, going from $1.16 million to over $5.4 million for the 6-month period. This is clearly a result of their new investment strategy. So for the 6 months ending the 30th of June 2026, net income was about $43.7 million, up from $39.6 million in 2025, a 10.3% increase. The company also provides a non-GAAP measure called Adjusted EBITDA, which tries to show the core operational profitability. For the 3 months ending the 30th of June 2026, Adjusted EBITDA was about $29.9 million, very similar to the $29.5 million in the prior year. For the 6 months, it was $56.5 million, up from $54.8 million. While net income has grown, their adjusted operational profit is much flatter, suggesting that those higher general and administrative costs are having a significant impact on their core business performance. And when we look at free cash flow, which is cash from operations minus capital expenditures, it has really fallen. For the 6 months ending the 30th of June 2026, it was about $40.3 million. Down from $56.3 million in the same period of 2025. A big part of this is due to their investment in those US Treasury securities, which used up a lot of their cash. On a positive note, the company did authorize a share repurchase program. They bought back over 726,000 shares in the second quarter of 2026 for about $10 million. They've since completed this program in July 2026, buying back shares for a total of around $12 million. This can sometimes signal confidence from management, but it also uses up cash that could be invested elsewhere. One of the biggest risks they highlight is customer concentration. They heavily rely on a few major customers, many of whom are related parties, meaning they are connected to their controlling shareholder, HCI for example. 2 related party customers accounted for almost 87% of their revenue in the first 6 months of 2026. Losing even one of these major clients could significantly hurt their business. This reliance on a small group of customers, especially those tied to their parent company, is a significant vulnerability. They also mention that they are not currently involved in any major legal proceedings that would materially impact their finances. That is always good to see. And in a subsequent event, they announced the formation of XZO Ventures, a new division focused on AI products and services for the insurance industry, especially in areas like AI-driven claims and underwriting. This shows they are looking to innovate and leverage new technologies for future growth. Looking at the management discussion, they emphasize their reliance on technology and their platform. They see intense competition, and they are focused on acquiring new customers to reduce their reliance on those few big ones. They also mention the evolving regulatory landscape, which is always a factor in the insurance industry. Their strategy seems to be about leveraging their technology platform. They aim to expand into new geographies and insurance programs, which is a standard growth strategy in this industry. However, the increasing operating expenses, particularly in selling, general, and administrative areas, are a concern, while their net income is growing. A significant portion of that growth is being offset by investments and higher operational costs. The shift into US Treasury securities suggests a more conservative approach with their cash, perhaps a response to market uncertainty or a desire to preserve capital after their IPO. The biggest area of concern for me is that massive increase in selling general and administrative expenses. It is almost doubled, and that is eating into their profitability. While they are making money and expanding their revenue streams, the cost of doing business is rising fast. The heavy reliance on a few related party customers also remains a significant risk. However, the move into AI with XZO Ventures could be a smart long-term play to drive future innovation and potentially diversify their business. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.